Hey everyone, welcome back to Corporate Decoder. Today we are diving into a company that's betting big on second chances, kind of like that questionable sandwich you left in the fridge a bit too long. We're decoding Conduit Pharmaceuticals' latest filing to see if their strategy of repurposing old drugs is a stroke of genius or just plain moldy. Conduit Pharmaceuticals filed a report with the Securities and Exchange Commission. This report tells investors about important events that a company is required to disclose. In this case, the report is about a new agreement and the sale of some company stock. It's dated March 31, 2025. The main event here is a new agreement with a company called Saborg Limited. Think of Saborg as a high-tech detective agency for drugs. Conduit is paying Saborg to use its special computer programs to look at old data from some drugs that didn't quite make it to market when AstraZeneca, a big pharmaceutical company, originally developed them. Conduit hopes Saborg can find new uses or identify specific groups of patients who might actually benefit from these drugs. This could save Conduit a lot of time and money compared to developing completely new drugs from scratch. The specific drugs they're analyzing are called AZD1656, AZD5658, and AZD5904. They're handing over all the previous clinical trial information to Saborg, hoping they can find hidden clues in the data. It's like looking for a needle in a haystack, but with computers. For this data deep dive, Conduit is giving Saborg a license to use their fancy algorithms. This license allows Saborg to access and use Conduit's information. It is non-exclusive, meaning Conduit can also give other companies similar licenses, and it is also non-transferable, meaning Saborg can't just hand it off to someone else. The deal with Saborg is going to last for 6 months, and Conduit has to pay them $2 million. This payment includes a fee for the license itself. Conduit gets to choose whether to pay in cash or with company stock, using the stock price from the day before the agreement started. Conduit already paid some of these fees by issuing over 1 million shares of stock, which covered approximately $1.65 million. Basically, they gave away a piece of the company to pay for these services. The full details of this agreement will be available in Conduit's next quarterly report, a Form 10-Q. There was an earlier agreement from December of the previous year, 2024, which remains in place. Now let's talk about the stock. Besides the stock issued to Saborg, Conduit also gave away more shares to other consultants for their advice and services. Specifically, they issued over 400,000 shares to people who aren't directly related to the company. These stock sales didn't go through the usual registration process required by the Securities Act of 1933. Instead, they used a specific exemption that allows companies to sell stock without registering it in certain situations, in this case related to providing consulting services. As of the end of March of 2025, there were about 9.5 million shares of Conduit stock out there. This means that the original shareholders now own a slightly smaller piece of the pie because the company created new shares and handed them out. So what does all of this mean? Conduit is taking a gamble on finding hidden value in cast-off drugs. They're betting that Saborg's technology can unlock secrets in old data, potentially leading to new treatments and revenue streams. However, they're also paying for this gamble by issuing a significant number of new shares, which dilutes the value for existing shareholders. Now let's put on our Warren Buffett hats and analyze this situation. Conduit's strategy is high risk, high reward. On the one hand, if they can successfully repurpose these drugs, they could generate substantial profits with significantly lower development costs. This is a smart move if they can pull it off. On the other hand, relying on cast-off drugs means they don't have full control over the initial research and development, and there's no guarantee that Saborg will find anything useful. Plus, diluting the stock to pay for these services is a serious consideration for investors. Conduit's direction seems to be focused on innovation through repurposing. Their strength lies in identifying potentially valuable assets that others have overlooked. However, a weakness is their reliance on external parties like Saborg and their need to issue stock to fund the operations. The biggest risk is that their approach won't yield any marketable products, leaving them with little to show for their efforts, and a diluted stock value. In conclusion, Conduit Pharmaceuticals is pursuing an interesting, albeit risky, strategy. Whether it pays off remains to be seen, but investors should carefully weigh the potential rewards against the inherent risks before jumping on board. Thanks for watching. If you found this analysis helpful, please give us a like, drop a comment, and subscribe for more deep dives into the world of corporate filings.